If you're just tuning in, Al was shedding some light on how the institutions trade for income, how they trade for income in shorter term accounts. And it doesn't mean taking as many trades as you can and not, having emotional trading and investing. You want to set your trades and let them work for you. And that's what the institutions are doing. Now, Al, I want to continue that discussion, but reference that into retirement. How are the institutions trading, or I should say investing, in longer-term accounts like 401ks and IRAs? So these professionals that are trading or investing in these other retirement accounts, what are some of the things that they're doing, but they're not doing that for their clients?
Correct. What they're doing for their clients, essentially, in especially in the employer sponsored retirement plans, is putting them in mutual funds, maybe some ETFs, maybe some stock, mostly mutual funds. Which, one time mutual funds were probably a great way for people to be involved in the market with good diversification, but the fees have gotten so out of hand and they've gotten so large that the returns are pretty much mediocre, and you have limited choices. Mutual funds are only going to make money in an upward direction. They can't. Mutual fund managers cannot short the market. They can't go to all cash. They're pretty well just resigned to making their funds perform well in an up market. But here's the thing. I think successful traders in institutions, they invest their money to gain time instead of trading time for money. Successful investors in the institutions, they use leverage to trade. And most people use leverage to spend, with credit cards and things
everything
like that. So just kind of reverse that. Use every dollar as something that it will benefit and try to get as much production out of that. That's where the leveraged assets are usable and helpful. And the institutions, believe me, they are not just putting stock portfolios together. They're not doing mutual funds. I can pretty much guarantee you that. When you have a company like Goldman Sachs or J.P. Morgan, Morgan Stanley, Merrill Lynch, they are trading, sometimes they're trading stocks, sometimes they're trading the futures market, the foreign exchange market, the options market. We hit a little bit on the futures market before. Great leverage, say 20 to 1 or higher, trading almost 24 hours a day. Huge liquidity, much bigger than the stock market.
And just to clarify, Al, that leverage, you mean there's more buying power. So institutions and professionals use less capital?
That's correct. That's exactly right.
And now is that available to the public?
It is available to the public. Anybody can trade in the futures market, in the foreign exchange market, in the options market. But I guess my advice would be don't do that unless you know what you're doing. We talk about leverage being a great benefit, and it is. However, if you don't know what you're doing, you don't want that leverage to go against you. So the number one thing, if you're going to be involved in any market, even the stock market and mutual fund market, is to know how to protect your assets. And one of the tools that our students have is a trading platform. It's a trading educational analysis platform where one of the first things that they do is tell this platform the maximum amount of money that they want to risk on any individual trade. Maybe it's $200, maybe it's $100. It depends on the individual. But then that platform will tell a person whether that is a trade that will honor that maximum risk. So the risk can be controlled. It has to be controlled, especially if you're using a leveraged asset. Use the leveraged assets to benefit you, but just make sure that you're getting the greatest benefit out of them.
I just want to clarify, and you kind of made me think about something, is most investors think that they have to risk, whatever their portfolio is, that's their risk. Well, unfortunately, that's kind of how they invest, is they put all their money into one basket, so it's all at one risk. To clarify, investors and institutions, they're not taking their whole portfolio. They're taking smaller chunks of money, and they're investing with leveraged asset classes. In my mind, if they're using smaller amounts of money, that's less risk. That way, investors can be more comfortable, but also be confident in their investment decisions, and it is available to the public.
Correct.
Another thing you made me think about, you said the masses, the general public, uses leverage in their everyday life. You mentioned the credit cards, homes, cars. Everybody uses leverage in their everyday lives, but they're afraid of it in the market. It's not because it's new. It's just a little bit different.
Right.
And investors want to understand that and understand why the institutions and the professionals are using this leverage. It's a phenomenal opportunity to utilize because that's what they're doing. So understanding what they're doing can help you have better, confident decisions and just more financial literacy in your, in your life. You mentioned a couple things. You're talking about mutual funds and really how devastating they are in retirement accounts because of the fees. Mm-hmm. Now, a lot of people will say, "Well, I'm okay with paying a fee if the advisor or broker is making me capital."
Sure.
Right.
Mm-hmm.
Now, does that make a lot of sense? If investors are paying let's just say a small 1% fee or 2% fee, which over time, that's that eighth wonder of the world in a negative way.
Correct.
Compounding interest.
Negative compounding.
Talk about self-directing and why it's so profitable for them to self-direct because you can lower those fees.
Well, the fees can have a huge negative impact. As you mentioned, it's negative compounding. Every dollar that is taken away in a fee is no longer there to compound for you, to work for you, to create more dollars. Just a small fee, a couple percent, can have a huge impact. Maybe $30,000 to $50,000 or percent, of what you could have when you retire is gone because of small fees like that. And you're right; people just assume that the fees are part of being invested.
That's the part of being uneducated.
That's the part of being uneducated. And think about what Wall Street is providing for the fees that they are charging. In a 401k or 403b or the typical employer-sponsored retirement plan, and we ask this of people every time we have one of these free classes, how much advice are you getting? How often do you meet with an advisor or somebody that is controlling that plan, that retirement plan? Most of the time, it's zero. So you're paying a fee. Maybe it's 2%. It's probably more than that when you look at some of the hidden fees that are embedded within the mutual fund, and then there's a brokerage fee included there also. What is the value that's being received from those fees? Basically, people are their own pension fund managers. They are making the decisions, the initial decisions, anytime that they rebalance or want to make changes. For the most part, that's being done by the employee themselves. So why pay the fee? What if you could have a self-directed IRA? And by the way, we don't mean to bash those retirement plans as being not worth anything.
It helps people save.
It helps people save. And for most people, there is some kind of a match. That's free money. And that's the best kind of money is free money. But a lot of people, they have contributed to the point where they're no longer getting that match. A lot of our students will then put that money into a self-directed IRA where there are no fees, and you have many more choices, not just mutual funds, stocks, futures, forex, options. You can have assets that will provide benefits in down markets or sideways markets.
Al, I want to continue that discussion about self-directing. I think a lot of our listeners, and we've had a lot of people ask us about self-directing, on especially how much opportunity is actually out there in the institutions. If they're utilizing these different concepts and techniques, remember at the beginning of the show, they're always in the green. They're always profiting. So it's good to understand why they do the things they do, but also a lot of the things they do is also available to the public. So if you can lower your fees, what could that do over 10 years, over 20 years, or 30 years? I mean, think about this. If you're in your 50s, you're probably only halfway through your life. If you're in your 40s, you got a long way to go. And eliminating or lowering some of those fees could be a huge impact.
Right.
Also, don't forget to go to the podcast and subscribe, but also leave us a review on topics that you want to hear, especially in retirement accounts. Coming up next, we're going to continue the discussion on self-directing, but also how much opportunity are in these financial markets right now. We'll be right back.